Have you ever thought about a type of trading where the entire game is played out in just a few seconds? I'm not talking about days or even hours. I mean, literally, the blink of an eye. This is a world where profits are measured in cents, but believe me, they can add up, and fast. This is the world of scalping, and today we're going to pull back the curtain and see exactly what it's all about. So, here's our game plan for this explainer. First, we'll get a handle on what scalping actually is. Then, we'll watch a trade happen in seconds. After that, we'll check out the scalper's playbook, and finally, we'll decode some of the jargon you've got to know. Ready? Let's jump in.
All right, so what is scalping? At its core, it's all about capturing tiny little profits, but doing it again and again and again. You know, it's kind of like a hummingbird. It doesn't take one big gulp from a single flower. Instead, it takes a tiny sip from hundreds of them, and by the end of the day, all those tiny sips add up to a full meal.
Yeah, so let's put a real definition to it. Scalping is a trading style focused on grabbing these really small price movements. We're talking just 1 to 5 cents by holding a position for just a few seconds. That's right, seconds. So you can forget about long-term investing, charts here. This is a game of pure speed. It's like a surgical strike on the market. You get it in, you grab those few cents, and you're out before most people even realize the price moved at all. So what does a scalper's world actually look like?
Well, for starters, everything is built around high-speed, second-long trades. You have to be incredibly fast. You're also going to focus on highly liquid stocks, the big ones where you can get in and out without causing a ripple. The entire strategy exploits tiny price differences called bid-ask spreads. And maybe the most important piece of the puzzle, success absolutely hinges on ironclad, strict discipline.
Okay, so that's the theory. But what does this actually look like in practice? Let's walk through a trade, second by second, and see it in action. For our example, let's look at a fictional company we'll call Microchip Co.
All right, so here's the scene. Microchip Co. is just kind of stuck. It's bouncing back and forth in this super tight 5-cent range between $20 and $20.05. Now, for most traders, this is pretty boring, right? Nothing is really happening. But for a scalper, this is the perfect playground. So if we look closer at the order book, we see something interesting. On the bid side, at $20, it is stacked with large buy orders. That shows a ton of demand. But then you look at the ask side, up around $20.04, $20.05, and the sell orders are much smaller. That imbalance tells a scalper one crucial thing. Right now, the buyers are showing a lot more strength than the sellers, and that's the opportunity. So seeing that wall of demand, what does the scalper do? They act. A buy order goes in at $20.01, trying to get just ahead of all those other buyers. The clock is officially ticking. And just as they predicted, that buying pressure gives the stock a little nudge upwards, and boom, they're out. The position is sold at $20.04. The entire trade, from start to finish, probably took less time than it's taking me to explain it.
So, what's the grand prize for all that adrenaline and quick thinking? A profit of 3 cents per share. And I know what you're probably thinking. 3 cents? You did all that for just 3 pennies? And honestly, it's a fair question.
But here's the absolute key to understanding scalping. That small edge, that tiny 3-cent win, that is the whole strategy. It's not about hitting home runs. It's about finding that small, repeatable advantage and executing on it again and again and again. And this is where it starts to make sense financially. Look at this. A profit of 3 cents per trade on its own is nothing to write home about. But what if you could make, say, 50 of those trades in a single session? Well, now your potential profit is $1.50 per share. Multiply that by a decent number of shares, and suddenly those little pennies add up to some very real money. It is a game of volume. So let's get into the playbook. How do they do this consistently? How does the scalper think? It's definitely not random. It's a very systematic and disciplined process. It really boils down to 5 critical steps. First, they're constantly scanning the market for the right stocks, those with high liquidity and tight spreads. Second, they read the order book, just like we did, looking for those imbalances. Third, they plan the entire microtrade. They know their entry point, their exit target, and their stop loss before they even think about clicking a button. Fourth, execution has to be instant, no hesitation. And fifth, and this might be the most important rule of all, they respect their stop loss instantly. If the trade goes against them, they are out. No questions asked. All right, moving on, let's decode some jargon. Like any specialized field, scalping has its own language, and to really understand it, you gotta know the lingo. First up is order flow.
This is just the real-time stream of all the buy and sell orders hitting the market. Think of it like seeing the actual current of a river, not just what's on the surface. It shows you the real pressure that's moving the price around. Next, we have the bid-ask spread. This one is crucial. It's simply that tiny price gap between what buyers are willing to pay for a stock, that's the bid, and what sellers are asking for it, that's the ask. For a scalper, the smaller or tighter that spread is, the better their opportunity.
Okay, a liquidity pool. Remember that huge stack of buy orders we saw for Microchip Co. at the $20 mark? That is a perfect example of a liquidity pool. It's a big cluster of orders sitting at one specific price, and it can act like a support level or even a magnet for the stock's price.
And finally, fill rate. This is simply how quickly and completely your orders get executed when you send them to the market. When your entire strategy depends on trades that last just a few seconds, you absolutely cannot afford to have your order just sitting there waiting to be filled. A high fill rate isn't a luxury, it's a necessity. Now, for all this talk about speed and quick wins, there is a massive catch. And this quote says it all. A single large loss can erase dozens of successful scalps. Just think about that for a second. You could be right 20, 30, even 40 times in a row, but if you let one bad trade get away from you, it can wipe out all of that hard work, and then some.
And that really gets to the core truth of this style of trading. The most important skill in scalping isn't finding the big winners. It's how well you manage your losses. Cutting a losing trade quickly and without emotion is actually more important than finding a winning one in the first place.
So, this brings us to a really interesting final question to think about. When you know for a fact that one single mistake can wipe out dozens of your successes, you have to wonder, is scalping more about having the perfect strategy, or is it really about having the right psychology? Is it a game of charts and numbers, or is it a game of mental fortitude? Something to chew on.